You've probably heard the stories. A startup raises millions, grows at lightning speed, and looks unstoppable until suddenly it crashes and burns. What went wrong? In today's video, we'll explore why fast-growing startups often run out of money, and most importantly, how you can avoid the same fate. In the dynamic world of startups, rapid growth is often celebrated as a hallmark of success. However, this meteoric rise can sometimes mask underlying financial vulnerabilities. A significant number of startups, despite impressive growth metrics, find themselves grappling with cash flow issues, leading to premature closures. Understanding the reasons behind this paradox is crucial for entrepreneurs aiming for sustainable success. The paradox of rapid growth. Let's start with the paradox. Growth is supposed to be good, right? But growing too fast without financial discipline can be a startup's undoing. While scaling quickly can position a startup favorably in the market, it also brings a surge in operational costs. These include increased staffing, expanded infrastructure, and heightened marketing expenditures. Without meticulous financial planning, these escalating costs can outpace revenue, leading to cash shortages. According to CB Insights, 29% of startups fail because they run out of cash, making it the second most common reason for startup failure, after lack of market need. As your user base expands, so do your expenses. New hires, bigger office, more servers, aggressive marketing, all of which eat into your cash. Key factors leading to financial shortfalls in startups. Startup success stories often highlight rapid growth, major funding rounds, and aggressive expansion. However, behind many of these stories lies a harsh truth. A large number of startups run out of money far sooner than expected. Understanding the root causes of these financial shortfalls is essential for any entrepreneur looking to build a sustainable business. Below are 5 critical factors that commonly lead to the collapse of otherwise promising ventures. Mismanagement of burn rate. One of the most significant contributors to financial strain in startups is poor burn rate management. The burn rate refers to how quickly a company spends its capital, typically calculated on a monthly basis. Many founders focus on the gross burn rate, which is the total amount spent, without taking into account the net burn rate, which factors in incoming revenue. While a high burn rate can be justified if revenue is growing proportionally, in many cases, startups overspend on operations, hiring, or product development before securing consistent income. Without close monitoring, this spending pace can rapidly deplete available funds, leaving little room for error or unexpected expenses. Your burn rate is the pace at which you're spending money. Founders often focus on gross burn, total monthly expenses, but ignore net burn, which accounts for incoming revenue. Overestimation of revenue projections. It's not uncommon for startups to present optimistic forecasts when pitching to investors. However, basing budgets and hiring plans on these ambitious projections can be risky. If actual revenues fall short, as they often do in unpredictable markets, the company may find itself unable to meet payroll, pay suppliers, or cover other operational costs. This gap between expected and actual performance is often due to a failure to fully understand the sales cycle, customer behavior, or market demand. Startups should ground their forecasts in conservative estimates and ensure flexibility in their financial plans. Too many founders bank on best-case scenario projections. But what if your product doesn't convert? What if your customers take longer to pay? Reality usually hits harder than the spreadsheet. Premature scaling. Scaling too early is a mistake that can have devastating financial consequences. Founders may be tempted to ramp up marketing, expand to new regions, or hire aggressively before their product has achieved market fit. But without solid validation from paying customers, this kind of expansion often leads to inefficiency and wasted capital. Rather than creating traction, premature scaling stretches resources thin and magnifies existing flaws in the business model. Sustainable growth requires a strong foundation. It must be built on real, repeatable demand, not just assumptions. Growing before you have real product market fit? That's like building a second floor when the foundation's still wet. Neglecting unit economics. Unit economics is the study of revenue and costs associated with a single unit of product or service. Startups often neglect to properly calculate their customer acquisition cost, CAC, in relation to the customer lifetime value, LTV. If acquiring a customer costs more than the profit that customer brings over time, the business is inherently unprofitable. This imbalance may be masked during early growth, especially with venture funding, but will inevitably become a problem when cash reserves dwindle. Founders must ensure their acquisition strategies and pricing models support long-term profitability. If your customer acquisition cost, CAC, is higher than the lifetime value, LTV, of that customer, you're losing money on every deal. Inadequate cash flow management. Cash flow is the lifeblood of any business. Even profitable startups can fail if they run out of liquid cash to pay bills, salaries, or suppliers. Failing to forecast and manage cash flow can lead to unexpected shortfalls, especially when expenses and receivables are not aligned. Regular financial audits, cash flow statements, and scenario planning are essential tools for mitigating risk and ensuring liquidity. During tough periods, it's not just about how much you raise, it's about how you manage it. Failing to track your cash flow is like driving blindfolded. By understanding and actively managing these 5 factors, startup founders can avoid common pitfalls and build companies with real staying power. Strategies for sustainable growth. Building a successful startup requires more than just innovation and ambition. It demands discipline, adaptability, and strategic foresight. Many startups experience early momentum only to falter due to poor financial practices or unsustainable growth strategies. To ensure long-term success, founders must focus on sustainable growth, scaling the business in a way that balances speed with stability. Below are 5 proven strategies to help startups grow responsibly and avoid common pitfalls. Implement rigorous financial planning. Robust financial planning is the backbone of a sustainable business. Startups must go beyond basic budgeting and develop comprehensive financial models that reflect various scenarios, best case, worst case, and everything in between. These models should account for cash flow, revenue forecasts, expenses, and funding timelines. Importantly, financial plans are not static documents. They should be regularly reviewed and updated to reflect real-world performance. This allows founders to adjust strategies promptly, prevent overspending, and make informed decisions based on data. Build financial models. Update them regularly. Prepare for worst-case scenarios. Prioritize product-market fit. Scaling a product or service that hasn't yet found traction in the market is a recipe for disaster. Before pouring resources into marketing, hiring, or expanding operations, it's essential to validate product-market fit. This means ensuring there is real demand and that early customers find enough value to return and recommend the product. Investing time in customer feedback, product iteration, and user testing before scaling reduces the risk of costly misalignment between the offering and market needs. Don't scale until your product is truly needed by your audience. Let demand pull you, not just funding push you. Monitor and adjust burn rate. The rate at which a startup spends its capital is a key metric that requires continuous monitoring. Growth should be paced in line with revenue, not just ambition. If spending outpaces income too quickly, a startup can run out of runway. Founders must regularly evaluate where money is going, trim unnecessary costs, and reallocate budgets to high-impact areas. Proactive burn rate management ensures that spending fuels growth rather than undermines it. Know when to cut costs or pause hiring. Every dollar counts when you're building something from scratch. Focus on positive unit economics. Aim to spend less to acquire each customer than what they're worth to your business long-term. A sustainable startup ensures that each customer generates more value than it costs to acquire them. This is measured by comparing customer acquisition cost, CAC, to customer lifetime value, LTV. A strong business model typically sees LTV significantly exceed CAC. When this balance is achieved, it indicates scalable and healthy growth. Startups should continuously test pricing, optimize acquisition channels, and refine customer retention strategies to improve these metrics. Maintain a healthy cash reserve. Even well-managed startups face unforeseen challenges, economic downturns, delayed funding, or market shifts. Maintaining a cash reserve can provide a vital safety net, offering flexibility and time to respond strategically rather than react out of desperation. Founders should aim to set aside several months' worth of operating expenses to ensure stability. Through uncertain periods, always have 6 to 12 months of runway in reserve. Think of it as your startup's safety net. By integrating these strategies, startups can build a resilient foundation for lasting growth, one that withstands setbacks and capitalizes on opportunities with confidence. Final thoughts. While rapid growth is an admirable goal, it should not come at the expense of financial stability. By understanding the pitfalls that lead to cash shortages and implementing strategies for sustainable scaling, startups can position themselves for long-term success. Balancing ambition with prudent financial management is the key to thriving in the competitive startup landscape. Remember, it's not just about how fast you grow, it's about how long you last. Plan wisely, grow sustainably, and your startup won't just survive, it'll thrive. If you found this video helpful, give it a like, subscribe for more startup insights, and drop a comment below. Have you ever struggled with scaling your business too fast? Let's talk.